All right, so this is going to be our last video for our chapter on stockholders' equity as it pertains to equity financing, i.e. issuing stocks, paying dividends, and so forth. So I want to talk just briefly about the concept of earnings per share. And what we're going to be talking about is there are two different types of earnings per share. There's basic earnings per share, and then there's what we call diluted earnings per share. We're going to be looking only at basic earnings per share. This is a video for kind of an introductory sophomore level accounting class. So if you need diluted earnings per share, you will get those in your next accounting courses, or if you're a finance major, you will see those again as well. All right, so we're going to start off with a little true-false question here. It says, if a company has preferred stock, so if a company has preferred stock, the preferred stock dividend is added to net income when computing earnings per share. Well, actually what I'm going to do is I'm going to pull up the PowerPoint, and I'm just going to scroll down. Let's see, where are we at here? Right here. So we have the formula for earnings per share, and we've got net income minus preferred dividends, and our denominator is weighted average of shares outstanding. So net income minus preferred dividends. The preferred stock dividend is subtracted in that formula. So let's just go ahead and write the formula out here. So, excuse me, I dropped my pencil. EPS equals net income minus preferred stock dividends over, we'll just go with what the language on the PowerPoint slide, weighted number of common stock shares. And so remember how we get weighted average of anything. We're just using beginning and ending. So, but for our purposes, this word weight is not really going to matter. All right, you're going to be given the weighted number of common shares. So is that what it says? Added? Well, that looks like a minus sign to me. So this is a false statement. Earnings per share. Why do we need it? We've got four choices here. Earnings per share is the earnings available to common shareholders. Well, net income is earnings. When we subtract out the preferred stock dividends that are never going to make it into retained earnings, we can see that choice A is a true statement. B, must be reported by public companies. This is also a true statement. So we can see where we're going with this. This is a requirement. Remember, we said that one of the disadvantages of the corporate form of government is, I keep on doing this. The corporate form of business organization is government regulation. Well, this is part of that. They must, publicly traded companies must report earnings per share. C, helps compare companies of different sizes. This is also a true story. And I want you to understand something. Let's just say that we have two companies, and one company is just, a massive, like General Electric, Amazon, something like that. And then you're going to consider investing in that company. Well, if earnings per share is a big deal to you, we know that it's difficult for a larger company to grow because they've already grown. But they are bigger. They're going to have more shares of stock. But we can use earnings per share to compare this gigantic company with, say, $500 billion in revenue to another publicly traded company that has $500 million in revenue. And you're probably not going to be able to purchase all of the shares anyway. So for our purposes, if we're making an investment decision, for practical purposes, for our purposes, the companies are the same size. They're not the same size, but we can say, okay, if I invest in this company, I'm going to get earnings per share based on previous performance of $1.08 per share, but then this company over here, I might only get 60 cents per share. So this is important information. So, as you've already guessed, our answer is D. Finally, little calculation question. It says Oregon Incorporated reported net income of $105,000. During the current year, company had 5,000 shares of $100 par, 5% preferred stock, and 10,000 shares of $5 par common stock outstanding. The company declared and paid all preferred dividends. That makes things a lot easier. Oregon's earnings per share is, so looks like we're going to need our calculator. So let's bring that over here. All right, so, and actually I want to move that calculator a little bit over this way so we can see our formula. So earnings per share is net income minus preferred stock dividends. And we've been given net income here of $105,000. So let's just go ahead and put that. And I'm going to put a minus sign here. I'm going to put a big line to show you that we're going to have a fraction that we have to deal with. So minus preferred stock dividends. Well, what are the preferred stock dividends? Okay. Well, we're going to take the number of shares. Let's just go in order here. 5,000 times $100 par value times the 5% preferred stock dividend equals 25,000. So we're going to pay out, Oregon Incorporated is going to pay out $25,000 in preferred stock dividends, and they paid them all. Okay. And they're giving us, well, they'd have to give it to us, the 10,000 shares of common stock outstanding, and we're going to assume that this 10,000 is the weighted number of common stock shares. So this is not money here, this is number of shares. I'm going to go ahead, just to be absolutely certain that we're on the same page, I'm going to actually do this math. 25,000 minus 105,000, I'm sorry, 105,000 minus 25,000 is 80,000 over 10,000. And so, if we take 80,000, and you already know the answer, I know, divided by 10,000 shares, and we screwed that up, 80,000 divided by 10,000 equals 8, and that is choice A. Okay, so now we know a little something about earnings per share.